bit capped there. Be sure to sign up to the Substack, jo.substack.com. That's the URL. It's underneath my talking head. Free newsletter. There's a paid version where you're getting extra premium information, as well as access to a lot of extra resources. In addition to that, what you've got is different tiers. Please feel free to do that. I think that it's very, very clear to me, which is that I'm not posting just average updates. I'm trying to give you very, very specific information, which will help you get the idea of principles, because we know that there are going to be variations on those principles. And what ends up happening is that the information that you take away from posts, YouTube videos, news is about the result. And that can ultimately be misleading or leave you with the wrong impression. I'm not saying it always is, but it can be. And as a result, I'm trying to explain that to you. And that basically is the common thread across all of the posts and information that I try to provide. So, all of that stuff in mind, let's just get straight to it here because we're going to need to go quickly. So today's agenda is there on your screen. Let me just try and make it bigger for you and like black out my head a little bit here. So we've got a new product here from Blackrock. I'm going to get to it in just a few moments, and then we're going to talk about the financial markets observations and your takeaways. And there it is there. So very interestingly, this article out of Axios talking about annuities are back, kind of, and this is Axios market. And don't get me wrong, I have very, very high regard for Axios. Very good overall, very impartial reporter and of news and developments in many different areas. And so my shout out and compliments to them, absolutely. So anyway, let's just get on to it. So annuities are back, kind of, and for those people, as you can see there underneath my my talking head, again, I'm going to have to come up with another word, is that I'm an education fellow for the Alliance for Lifetime Income, which is a nonprofit organization which is used to educate advisors and the general public about guaranteed income products, which is another way of saying annuities. And it's very, very funny. It's very similar, like, well, I love the Affordable Care Act. I hate Obamacare. Well, in this very, very almost exactly parallel way, I love the idea of guaranteed protected income. I hate annuities. Okay. So it just goes to show you what ends up happening when people try to put labels because they don't actually understand what the actual labels are. Annuities certainly having the same problem that the Affordable Care Act had, or Obamacare had, right? In other words, they've wrongly assigned terminology in the wrong way, and now you have your takeaway, which is not correct. So here we go. Annuities are back, sort of, and this is the central idea, which is when you retire, you can take your retirement funds, convert them into an annuity, and rest assured that you have guaranteed income for life. At least in theory. In practice, almost no one ever does this. And I would absolutely say this is true, right? In other words, you've seen last week, and if you've not seen that video, go ahead and look at it. Well, after today, of course, after this broadcast, what you have is I explained what the three-legged stool is, which is, without redoing the entirety, this is what the traditional three-legged stool has been, right? Social Security, defined benefit, which was a traditional pension, and then savings and investments. Well, now what you have is Social Security, because of the fact that for most people, defined benefit pension income is gone, unless you basically work for a very, very few number of private or publicly held companies, something like 4 or 5%, and the rest being government or public service, where that is absolutely still in play or still exists to some degree. Even that is fading. Ask your local teachers. In many, many locations, the idea of the traditional benefit, traditional pension, is now also going the way of the dinosaur. Shout out to my dinosaur friends. Okay. So now what you have is that people then are responsible. And this is, again, still true. And this is kind of back to, and at least in theory, in practice, almost no one ever does this. And this is my point here. People are responsible. And now you can see it here because now I'll remove the black. And what do we get? What we get, we still have black, don't we? We reset this. And now this is this, which is Blackrock's new life path. So life path is their name for, it's their name for a targeted date fund. And for those people who are followers here on Jay's Corner, please look it up. I actually had an interview with Ann Lester, who used to run targeted date funds for JP Morgan Investment Management. So in other words, that's the playing field. That's the playing field. And I've not actually teased out every single quote, which I could have, all throughout the hour into extra 10-minute videos, extra 20-minute hour videos, even from little single question and answers that I received from her. In the interest of time, I didn't want to have a 10-hour video with her. She doesn't have 10 hours, and neither do I. Anyway, so we have possible outcomes. Large enough to fail, one leg disappear if the stool falls over, etc. Now you can understand with healthcare cost control, and now you can understand why I spend a lot of time on health insurance, Medicare. Simply put, the reason is because it is the other side of guaranteed life income, which is to minimize cost given your known health situation, right? In other words, if you're Mr. Sick a lot, you actually have to use more money because it's more valuable to you in order so that you can optimize your guaranteed income for life. In practice, no one else ever does this. Why this matters is one of the biggest problems with the defined contribution retirement plans most people have. They don't provide an income upon retirement, just a lump sum. At that point, retirees are largely on their own. Now, this is, candidly speaking, part or a very important component of what we are providing over here, which is the discipline. The discipline, I didn't say outcome, right? This is a conversation that we have, which is to say, look, we've got all these sources and levers we could possibly pull, and it's not going to matter. That's why I like having this as age, right? I didn't say that this matter happens at 67. I did not, right? In other words, the basic principles of this channel you can use at 35, absolutely. Which is what you end up having is you've got different sources of cash, and they should not be disregarded. And now you can see here, for example, you have extra structures, which is an annuities, insurance being two of them, right? And so now if I have an annuity and if you have insurance, which is life insurance, which is normally index universal life, both of which are reviewed in full for the most part, to the degree that I can share with you at that time, an explanation exists on this channel, both of them, right? In other words, that's the reason not to try to say, hey, this is the greatest thing or this is your one solution to everything, which is that they play a role possibly so that you can access money that you need to pay for expenses. In other words, to try to tell you how you can largely do it on your own. Annuities are the way that market converts a lump sum to an income, but they're generally seen as being opaque and unpopular. And this is the point of the ALI, right, which is the Alliance for Lifetime Income, which is to try to demystify, clarify the objective, the function of money. And again, we're talking about, what I'm talking about here, which is about how they're doing their job. I'm focused here on Jay's Corner about what the job is. And by what the job is, what I mean is convert this money, savings, however it would be throughout your lifetime, so that you can get to income that lasts forever. In other words, so that you don't outlive your money. Retirement crisis. We'll get to retirement crisis in a couple of moments. Between the lines, how to save money is broadly understood. True. You put aside a bit of cash each month. Now, usually from a large employer, for example, there's a 401k, and now there's automatic, enrollment into those 401ks. How you spend the money in retirement and confidence you're going to run out is a much tougher question. That is the point of, a crazy person's endeavor to write a published book, which is available on Amazon for less than $15. That's maximizeyourmedicare.com, by the way, for those people who are retirement or approaching the age of 65, expanded to the Affordable Care Act and the Advanced Premium Tax Credit, which is so that you have confidence you're not going to run out. And this should not always be seen as a negative. I don't want to leave the idea that this is necessarily a negative. Because the fact is that I've helped those persons have the confidence, even more confidence, and unlocked thousands of dollars a year for people so that they could retire early and get on with it, because they didn't live to work. They wanted to work to live. Now, I'm not here to tell you which way to run your balance of your own personal philosophy, life philosophy, but rather to say, okay, if that's what you want to pursue, let's see if we can get there. And that is a much tougher question. I don't think that there's any doubt. So Driving the News has officially launched its Life Path Paycheck product on Wednesday. This is brand new. How it works: a handful of corporate partners, including Adventist Healthcare Retirement Plans and TVA retirement systems, will default new employees into Life Path Paycheck funds, which are replacing their traditional targeted dated funds that move increasingly into bonds as your retirement year approaches. Now, I've spent a lot of time here on this channel talking about those funds, right? In other words, if you can see it here, Life Path, let's just look here quickly here on Google, and you can see it quickly coming up on my history, which is that this is, for example, the index fund. And you can see, by the way, right, you need to be careful on takeaway. I'm going to slow down here because I'm going to say, I've said this throughout the channel, right? Which is the headlines look like this up, all-time high, that up. The smartest guys in the room here for 2030 are year to date 1%. Year to date, even after Friday. We'll get to that. Don't get me wrong, and I'm going to stop here, and I need to pause and make this tangent. Very, very frequently in financial media, what you will see here is Blackrock, Vanguard are manipulating this. They're controlling the economy, this, that, and the other. If you go on TikTok or if you see YouTube shorts, and it's not going to matter, Instagram reels, you see these short little snippets and where people are trying to throw rocks, no pun intended, at Blackrock or Vanguard to say, hey, they own all of these stocks. That should not be allowed. Let me be very, very clear. They're not the owner, period. I can't, whenever I see this kind of thing, literally blood starts boiling and it's about to come out of my pupils. Because you own shares or units of a particular fund, and that structure owns shares of Bank of America, JP Morgan. When they pay a dividend, who's the beneficial receiver? You are, not BlackRock, not Vanguard. Nevertheless, I promise you, there are hundreds of videos which are saying these guys are manipulated in that particular way. That is just a fundamental misunderstanding about what is actually going on. It is gross. Because as a result, the narrative then becomes negative to a degree where it is just like a blatant untruth. And it is displaying the fact of how little is known about the world of finance. Let's just continue before I lose my mind and can't talk anymore. Back here to BlackRock here. So now you can see a couple of interesting things. Number one is that now the default. By default, I'm not talking about lack of payment, meaning that you're a new employee at TVA, and now you're going to automatically be enrolled into a Life Path Paycheck Fund. So the TDF sellers and Lester and JP Morgan Investment Management, BlackRock, Vanguard, Fidelity, they've all got them, right? Which is that you had a default. That is a fairly newish evolution, that if you didn't have any interest whatsoever, totally uninterested, don't care, don't want to know, you would be defaulted into a targeted date fund. It's not going to be academically wrong. There is no chance that it's wrong. Okay. And I don't say no chance lightly, right? Because people know that I am too even-handed for that. But, right, the idea that the creators of all of these images here are all simultaneously wrong at Vanguard, BlackRock, Fidelity, doesn't matter, T. Rowe Price, Hartford, you name it, they've all got, and they're running on this structure. It is how they're handling it which will make the matter in difference. And the fact, again, more evidence of how far away you are as a private person in understanding how the mechanics of portfolio construction get built and how that fits into your strategy. That's the point here. I'm not going to be, while today's not financial advice, you'll definitely not hear me saying, okay, well, buy Jay's Rib Shack stock because the target price is 30. That I'm very, very comfortable in saying is that something that I will never say, other than to mock Jay's Rib Shack, which is still the best rib shack in the country. Anyway, I know nothing about ribs. So let's just continue on here. So BlackRock here is that the fact that what ends up happening is target date funds that move increasingly into bonds as your retirement year approaches. Absolutely the case, right? So in other words, life path here, which is, this is targeted at someone who is 65 in 2030, which is still 6 years away. So now this is basically a 60-year-old. Okay. This is the average case, by the way, and there are limitations, as people would know here on Jay's Corner, about what I think about, the construction of averages. So now let's go back here. Now behave identically, except for until the employee is 55. At that point, the fixed income component starts to get switched over to something called lifetime income, which includes things like forward contracts rather than plain vanilla bonds. I think that this is the evolution. This is the evolution. And I'm going to show it to you here, which is normally what you have, and let's just look at the timeline for Mr. X. What we are doing is thinking through this here, right? And this is what it is doing. So now let's just say you have it 100 units, right? And now let's just call yourself 50. Let's start this at 56. So now what is happening, right? Instead of 100 all at one spot in a targeted date fund, and I'm just going to make up a number, right? So now let's call it 90 and 10, right? And let's just call it forward contracts. Now, full disclosure, I'm not going to be talking about very specific math here today because I've not had time to read through every last detail inside of the prospectuses, if I can even access it. I would be able to understand it. Let me just segue here. I would be able to understand it. I have been on the writing end of the most complex contracts, including what Ann Lester talked about on targeted date funds. In other words, the finest print in there, I've been involved firsthand, including with the conversation with the attorneys who then ultimately anointed those documents. So let's just continue. Section 1, Section 2, forward contracts. So what you can see here is that this seems to be that the fixed income component starts to get switched over to something called lifetime income. So now let's just call, and I'll just increase it even more, right? So let's just they've called this, stocks. And this one, other than the typo, let's just call this now bonds. So what is actually happening here is you can see this, right? Which is that if we look over here, what you'll get is this kind of portfolio characteristic. And they're telling you kind of. And like I said, very interesting conversation with Ann Luster because she told you also what the fine print, and which is why I swerved, which is that yes, in general, this is the case. And they're not going to wrongly or untruthfully state facts. No, that is not going to happen. But rather, your takeaway here is what's going on inside. And here are holdings, right? In other words, this is dated, right? Because they're not going to report to you every single day because these are going to swing around internally. They have the right to do so. They have the right to do so. That's the point of the fine print. That's actually Anne told us this, which I knew, but it's totally fine. But you can see here that what they would do is take some of the bonds that you can see here, 1, 2, 3, TIPS bond, U.S. government bond, credit bond, for example. So now you would see that they would start to merge or take some of this, morph some of this stuff, right? And let's just say that now this is, which to me, candidly, is still too high. And we'll talk, as I've stated in the past. But now instead of 65, and now let's just call it 30, and now let's call this 5. Right? In other words, so they're going to start taking this, and let's just call this 6. I'm just making an example. Right? And now what you get is 29, 28, 27, right? And they're like, let's just say that it's 65. And over time, this starts to decline because every 5 years it declines, right? So, or every 10 years on these targeted funds. So what ends up happening, let's make sure. Nope. What did I do wrong here? 29, 28, 27, 5, 6, 5, 6, 7, 8. Skip the number. So you can see what they would be doing. And then now you've got this extra bucket. And in this extra bucket here, that could be the returns on the will be similar to the returns on normal, but because of the way it's constructed, the new can be particularly easy to convert to an annuity. And now you can see that they will take this number here, which has now been allocated to there, and convert this into an annuity. You have the option to convert to annuity. So this is ultimately what the structure is. And this does, in my view, it absolutely addresses some of the discipline that I've talked about here throughout Jay's Corner and when I'm talking about Mr. X showing you this particular Google Sheet, which is we are talking about these sources of income, but then ultimately what's the job of the money? The job of the money is to create funds for what? To pay for expenses and other things. Don't get me wrong. I'm not the person to say to people, hey, you should not dream about taking a cruise to Alaska. You'll not hear that from me, right? In other words, I don't have the idea that you would sit on your wallet and underspend under retirement. And the reason I'm doing that is because I'm giving our clients the confidence by pinning down these numbers very, very accurately within bands so that even if randomness occurs, which it can, that they have a very good idea about what the guardrails are, even if randomness hits them, strikes. And that can run in the positive also. It is not, right? Availability bias tells you that the randomness is always negative. No, in fact, I'm going to tell you that NVIDIA, we're going to get to that later, right, is actually the flip side of that coin, at least for Friday. So now what we have here is that daily expense. So in other words, my point is that what this does do is that the new particularly easy to convert to an annuity. Once the owner of turns 59, have the option at any point for the rest of their life to convert the lifetime income funds into an annuity provided by an insurer. So, if you look on YouTube, you will hear never this, never that. And now they're sitting there as evergreen material. That's what YouTubers call it, right? Evergreen educational material. And this is why you need to keep up to date, because the reason that people would have stated don't put annuities into qualified funds is due to the fact of the RMD rule. And basically, what ends up happening is you would have two buckets, one for an annuity, one for your 401k. And as a result, it increases your RMD more than you would find desirable when you're trying to reduce your RMD. Well, the Secure Act fixed that. Secure 2.0 fixed that, which I knew was in development, right, the entire time. And this has been on for years, which is, kind of why I didn't make this post. I would have not made that video at that time, is I knew that this was part of it. Here is from one of my colleagues at the Retirement Income Institute. Fred Reich is one of the heads of research from there. And he's the one that I hijacked about, I'm gonna make some admission here. What is the job? This point is his point. He's an attorney. Is that the regulations about how professionals are doing their job? He said this during a monthly meeting. I'm like, I committed that one to memory because, in fact, that's precisely the way that I should have stated it this for years. And I'm like, dang it. So here we go. Is that provided into by an insurer, you do not have this problem that existed anymore. And here it is here. I will show it to you in try to secure 1.0, remaining obstacles according to annuities. And this is number one, requirement distribution issue. And there it is there. And now what you have, penalty on partial annuitization, etc. And now instead you have it here, elimination of the problem. And that is a development from Secure 2.0, which is actually, years in development prior to its enactment. This clause I knew about was being discussed. And as a result, no reason to say, okay, never say never. The reason is, and this is reason for that you'll want to keep up to date on rules changes. Nothing is stopping governments from changing rules. So here we go. The catch, the annuities won't be indexed to inflation. That is always a negative, right? Which is that the calculation is not, generally speaking, indexed to inflation. There can be variations, okay? There are variations which have this idea of inflation indexing for payouts when it comes to annuities. I'm not going to discuss whether or not I think that's a good idea. It's open-ended to some degree. I don't believe, well, I am going to discuss it now, right? It depends. And it depends on math of money. And you'll need to squint at numbers. There's no shortcut to it, is what I would say. Retirees are taking counterparty risk of the insurers and trust that they won't go bust. Okay, so this here is something I don't like about this article. I do not, let me just state this. I lose 0 winks as a result of worrying about Prudential going bust. That is just simply no. Right? MetLife, the of the insurers. I just don't believe that they're too heavily capitalized. I didn't say go to, Jay's insurance company in a shack, in Timbuktu. No, I didn't say that. But if you are on the largest insurers, no. I just don't have this view. Because the reality is this is so... During the time that would happen, you would have such other larger systematic problems. This doesn't register on the number of problems the nation would have. The insurers are acutely aware of the so-called adverse selection effect, who tend to be precisely the type of people that they're going to live longer than a dry actuarial table might suggest. Absolutely. This is a very interesting and subtle point. Congratulations to Mr. Salmon. Is it Salmon? Salmon. Let's just call him Mr. So Felix. So he's the author of this article. This is a very, very good, interesting point, right? Which is that, yes, the annuity tend to be precisely the kind of people who have reason to believe that they're going to live longer than a dry actuarial table might suggest. Yes, no kidding, right? And so you can see why I've also, now you can understand its combination with health, right? Meaning that if you're 56 and you're Miss Perfect and your mother lived to 120, guess what? You cannot just plan until you're 80. That will not work. That is not your average case. That's not your that's not my central prediction is what I should say. Should not say average case, right? My central prediction for you at 55 when your great grandmother lived to 110 years old is not going to be that all you need to do is plan until you're 80. No. Absolutely not. As a result, what does that mean? That means its ability or the attractiveness of these extra structure changes. And I'm slowed down. That means Mr. Sick a lot, right? I used to call him Jabba the Hutt, right? Which is that you're 900 pounds, you eat rodents as your diet, you're type 1 diabetic, and you are, liver cancer survivor, you're not worried about 100. I'm sorry. In the absence of some scientific miracle. It can be other types of miracles as well. I've seen it. But my point is that you're not really thinking about reaching 100 years old. Therefore, annuity being the right thing for everyone, you would not hear that here on Jay's Corner. Be sure to like and subscribe and hit the notification bell. But anyway, you can see it here. That's true. And the point here is that I want to point out that means also the reverse is true. That in the same way that a person who is Mr. Sick a lot, I didn't say annuity good for every specific situation. What I did say, however, though, is that let's not just cross it off all, Ken Fisher, I hate annuities, right? Just as a blanket statement. One of my other guests, Suzanne Norman, who is now the head of external relations at the ALI, said, put it very, very, very smartly. Her answer is, oh yeah, what kind of annuities do you not like? Right? There are so many different variations, right? I hate health insurance. Well, Medicare is part of health insurance, right? So anyway, my point here is that I would not say that any product of any label or any, it can be universal life. It can be it called what other people call short or junk health insurance. I don't call junk. No, I would not. The implication is incorrect for some. In the same way, I wouldn't say necessarily annuity that guaranteed lifetime income is necessarily useful if you're Jabba the Hutt or Mr. Sick-a-Lot. I do think that at least should be thought about if you're Miss Perfect and all of your female predecessors in your family live to 100 years old. Now you've got to think. Prudent to think. At least think. I didn't say conclude. The amount annuities pay out there is therefore conservatively calculated. And now here's the rub, right? Because of this, right, and this goes to show you something about, and game theory is probably too exotic. Private people private people completely miss this, candidly, right? Which is, people think that they're deterministically able to predict the future and etc. as if the other party is uneducated with no data. That is wildly wrong. Wildly wrong. In every situation, let me just put this really clearly, because you can change this. You can take this statement for every financial contract, and I mean every, which is the carriers have figured this out. They have way more mathematic data. That data is going to be correct. They have unlimited calculating power and legal resources to document their rights. Now, That doesn't mean that they're going to do something unlawful. I wouldn't say that. I don't say that, right? Those are legal, binding legal contracts. But the idea that you're going to outthink them in terms of, okay, what this calculation is supposed to be, right? They have a reason because why they've thought through this. So as a result, they have done this. Of course, and to which you subscribers here, you should shrug. Newcomers, this may be news. And the reality is, as many existing subscribers, this is still news, and this is why I have to keep repeating it, is because this is the type of thing that people overlook all the time. All the time. Please do not do this. The other guy has iterated under game theory and scenarios with unlimited computing power. Period. There is no way. You think I came up with this structure here by myself? And, this is physics over here. Of which, by the way, a lot of the calculations of finance can be basically boiled down into physics, to be candid with you. I know nothing about physics other than, some apple hitting some guy on the head as a proving that, there's something called gravity. My point here, and the reason I'm being this emphatic, I can't believe I'm this fired up over this point, right, is that this creates bias and error in in every judgment on every topic. Every. And this is why Jay's Corner is actually better for people in younger ages, because now you can understand and just think, I didn't know you 10 years ago. If you had known this fact 10 years ago, how many narratives have you listened to and bought as fact and now aren't? And they never were, not 10 years ago. That was also wrong. Those narratives were also wrong 10 years ago. Which is, oh, by the way, I hate Obamacare. I love the Affordable Care Act. Right. Give you an idea. Because are retired and annuitized, only about 30%. So now it tells you about 30% of the funds. So now you can see what they're doing, which is that this seems to be, without seeing, this seems to be a maximum of 30 at some point in time, right? At some point, this is the number here. Okay, so now what we don't see is what happens out here and what's the rest of the allocation. Where is the 70? And we're going to end up being so small that most people think the deal is worth taking. I don't necessarily, I think that still remains to be seen. Most people don't think the deal is worth taking. I'm not sure that that is the case. And the reason I say that is the following, and we come back up here, right? And let's just say your Social Security is $2,500. Right, you're 60. You're at full retirement. You're at 67. Right, and if you had a particular amount and then it turned into an annuity, and then you annuitized it into an income that could last, and you're now the 67-year-old Miss Perfect. I may do this for smaller amounts. That depends on the buyer after going through how the numbers actually fit. So you can see what they're doing is they're going to, now let's just say, for example, you're here at 30, right? And let's just call this 30, 30, and that makes this 40, okay, at this time. And let's just blank all this stuff out, right? In which case, what I would say is, that doesn't invalidate the point. No, because now, for example, now you've got 70 instead. And this 30 here goes away, and instead that 30 has turned into, 30 times 0.05, 0.06. Let's just, and that's pretty close. So 1.8, and this 1.8 then goes on forever. And this is 1.8% of the 30. So we don't, so at $100,000, right, this is 1.8 a year. So now we got 1,800. I don't necessarily think so because we are not doing anything other than just adding this up, right? So now we're talking about 100,000, and this is just for 100,000. This is for $100,000, IRA 401k, and now you can see it. And now and now you have to divide it by 12. So if you took it and multiplied and not made it monthly, but just instead make it annual, just for a number here, let's just call this 2,500 times 12. So now you're talking about, okay, now, in other words, I'll take every dollar depending on what its function is. Because if this is enough to pay for rent or pay for, known expenses, and then and also has this function to never outlive your money, okay. In other words, I didn't say that one of these line items in isolation will make the entire balance to work out. In order for one to be that, it would have to be so big. Instead, what I would do is I would think about, okay, what are these components? How do they add up? And then what we are doing is, as I told people in the past, you start backwards. You start backwards by taking expenses first, then filling in blanks here along the way and seeing if it fits or not. And from there, you then make choices down here. Because you don't control the answers out here, which is the part of, we're quickly getting to the NVIDIA 15 minutes. So anyway, here, big picture, the 3.5 trillion, there's no such thing as low fee annuity, index fund standard. Bottom line is as simple as index fund. Blackrock does at least move in that direction. So shout out to them. There's no question here, in my view, which is that this has a huge pro, which is that the discipline, what we are doing over here on the comprehensive financial planning is providing the discipline on what this exercise looks like. What it actually looks like. And this does not mean it's a crisis. It doesn't mean that, that you need to keep working and die at your desk. I didn't say any of those outcomes. It depends on what choices you make based on the facts that we have today. What Blackrock has done, though, is they have certainly introduced the idea of the discipline about going from what people wrongly do over here, in other words, on the three-legged stool, which is to deal with that people are responsible. People don't do this in practice, as the article rightly said, and now you can see its place on the planet, which is that this then is adding the discipline to what is gone, which is this. Right, so I don't have the ability to draw arrows and things like that, but you can see its fit here. So let's make them different colors, right? Which is that, in fact, this new guy, this new product at these locations is then trying to add some discipline to the fact and deal with this. In that they get A+ here, no question about it. Now, that's true in principle. Okay, that's the theory. The theory about the way the structure works. Theory and practice can be different. That doesn't mean that you should not understand the theory. It doesn't mean that you should stop trying to understand what the setup is. Because only then can you take away the right information that suits you from a random piece of data that you are wrongfully clinging to as your fact of the way that the world works. If it conflicts with theory, the fact is the outcome has to be discarded as random. You need to be super disciplined about it, and it's tough. That's why I keep saying it. Which is that You have theory. We know that the setup is this, but you know what? The outcome is just weird. And you need to consider that. So, do I need to change my setup? No, not if your theory was correct. Or the theoretical setup wasn't exactly right. Your plan wasn't exactly right. Your thought process in developing this timeline wasn't exactly right. Okay, that's different, but you still also don't have a single event, even if that time frame is 3 months. Definitely not. 100% not, right? And with that, we're going to go now to we're going to go now to financial markets here. So not very much time. There's a reason for it. On Friday, I'm going to show you this, right? On Friday, what did I do? I went and made this video here. Let's see if it shows up. There it is. So I'm going to move my head. See, there I am talking, right? So I'm going to show you this video here because I'm showing you about something that almost nobody would know. That the volatility I'm not going to talk about Google and Microsoft and Meta, candidly. Except for to posit one thing. I defy you to find me the person or persons that systematically chose long Google, short Meta to get them both right. That basically, if you had $5 or $100 on Meta and $100 on Google, guess what? Over this week, you're flat, right? Meta's down 10%, Google's up 10%. The net between the two is 0. True, right? This is why I don't spend lots of time talking about, okay, well, this stock is definitely doing that or that stock is doing the other. No way. Because if that were the case, then someone out on the planet has systematically been able to do that. Guess what? That person is no longer in public view because they're so well off, they're not going to share that information with anyone. So nobody knows about it except for that person singularly. That person doesn't exist. There's a reason for that because the theory wasn't correct. They didn't have some Rubicon or some Rosetta Stone by which to systematically do that. And again, if you have a crystal ball to do that, you don't have to be doing this for very long. Wednesday, we're retired, but call me up. You're retired by Wednesday, and I'll be on your coattails because I'll just be mimicking you. Let's go on to here. So this video is something that I made on. And let's see how much and then how much I rambled. So let's just go here. My point here is that this is very, very volatile. And you can see here because now, the likelihood of going up to all the way to 890, people are only paying 10 cents. And by 10 cents, it's basically, this is $10 for 100 shares. Why am I bringing this up? The reason I'm bringing it up to you is the following. Is that when this types of things happen, Wall Street, the sellers of the dealers of these options have to hedge. And they hedge it using, the Black-Scholes formula, which is here. Okay. So here it is here. This is the point then, right? This is the point of what I'm trying to say. That so many different things are wrong with people's takeaways, right? So NVIDIA went up to 877 at the end of the day. Let's just take a look. Here it is here. 877.35, up a whopping 6%. Let me just tell you, this cannot be seen as normal. Which is, and by normal, I mean regular. In other words, we should not be having, right, a stock this big running around at 6% a day on no news. Shouldn't. Instead, the explanation is the following, which is the video that I made here when I was talking over here, right? Which is the video I was making here on NVIDIA. And let's just see if I can get back there. I seem to have lost it. Yep, there we go. So, by the way, I'm going to have one tangent here, right? Which is basically assessing the probability of NVIDIA being over $875 in my example. Well, oh yeah, by the way, ND1 right here is not coincidentally what? It's the probability as determined by what? Oh, the lattice that I've been showing you. Meaning you can see the connection here amongst all of the different topics that I mentioned, which includes health insurance, which is you're buying and trying to ascertain, try to get an idea about whether or not this is worth it. Well, every day that financial markets are open, this type of instrument is trading all the time. And so now you can see that this is complicated, right? Because what ends up happening is you've got options which are that volatile, pushing around the stock. And if you don't understand that this is the activity which is going on, your takeaway is, oh, the world is great and NVIDIA is up to 877. See, my stock picker guy is right. When in fact, that person also who has guided you also doesn't necessarily and I'm sharing information with you that the professional market knows for sure, the actual professional market, right? And you can go to my channel and on the people on the playing field on equities would be able to understand this, right? Which is that the delta hedging of this construct here has created the move in NVIDIA, and the fact that it's in that order is the distortion, right? If this happens to Jay's Rib Shack, let's say I'm a penny stock and I've moved up and down by 6%, no problem. No problem. Why? It's a penny stock, right? And as a result, it has no influence on stock markets as a whole because those are all weighted averages, except for the Dow Jones 30, Dow Jones Industrial Average, which is why I basically turn off my ears every time I hear the Dow Jones Index Average, right? That is like one of the craziest examples of the misuse of the word average, right? It is average because it took every company and divided by 30 as if they were equal influence on the world as a whole, which is nuts. Here, what you have is that this construct of these people trading around this stuff that on options who have expiries every single day and especially on a Friday, because there are multiple options on Fridays. I tell people, look, I'm not going to suggest to you when you would change your portfolio and this, that, and the other. This is not financial advice. That's not the point of Jay's Corner. There are trading channels. You can see it on YouTube, etc. The only ones that I would have suggested are those for the S&P 500 futures because because individual equities can't be manipulated in this way, or indices. Futures markets, no way. And the fact that a stock this big, 2.2 trillion, moving around 6% a day tells you what? What's your takeaway? That whoever's doing this is huge. And they're doing so violently in this way, and that means it's also not these guys here. They are not reallocating this violently at 6% to move around the stock at 6% on a given day, right? Because that would have also meant what? That also would have meant that, oh yeah, by the way, it's been down to what? 762. 10% in a week. And this is actually is the close, right? So you're talking about what? It is, this is 762. This is actually not where it was trading during that particular day. It was way lower on that day. That was the close. My point here, as an illustration, is that the idea that you take some particular singular piece of data here and say, oh, as evidence, is like wrong setup, wrong ball placement, bad grip, terrible takeaway, ball in the fairway. See, it worked. Therefore I was right. No. Because for persons in NVIDIA, in this particular idea, right, who didn't understand that in fact, this is pretty bad, isn't it? In other words, the people who did not understand that in fact, that this is the stuff that was going on the entire time, right? That this stuff was the stuff that was going on the entire time, right? Are missing out on the fact of what has then driven not only NVIDIA, but it has driven the market as a whole because of the fact that this becomes then the way that the indices are made. And we're going to get to this which is now I'm over, right? About replication. The point from the other day video that I made was the fact that someone's hedging, right? Which is that, okay, someone bought an option. Someone bought an option from you. You've got to do something. Right? You're Goldman Sachs, you're Morgan Stanley. You're the option seller. What do? What, you're just like short, naked? You're not. Right? If that's your impression about the way the financial markets work, just please do not have this idea. That is not correct. Right? They have no choice. So now you're Bill the speculator, right? And you are like giga wealthy, right? You have $5 billion to your name. And you say, okay, I want to pay $50 million for an option that I just showed from the previous video. Goldman Sachs is the seller. What they're going to sit there and just say, okay, let it ride. If it goes up to 900, you win. And guess what? They've lost. The only way to prevent that, what do they have to hedge. How do they hedge? Replication. That's why I've got this slide here. And replication then becomes my example of minestrone soup. But I've used this on multiple occasions as my analogy to try to explain financial concepts. The dealer community, and this is just a very specific example of it, which is options are hedged. Guess what else is hedged? Annuities. Guess what else is hedged? Life insurance. From the inputs, then you get the price. But what ends up happening, as I just have said, and this now you can understand why I've been sitting here this in such an animated way, is that when you don't understand this is the way that the theory about how it works, then you can easily get distracted by just the outcome. Very easy. Sure. Why? Because you went on to CNBC.com, and it's not going to report incorrect facts, but they're there to sell eyeballs and clicks and views. And don't get me wrong, I point out CNBC only because it's the most visible that you can see on TV all the time. There are many, many other sources of this. So now the challenge for yourselves. Okay, so now you can see, right? You can buy Progressive Soup. You can try to make it from scratch. Now you've got a bunch of questions, right? Do you have a chef who knows what they're doing? If you're a private person and you're gleaning some like overriding principle about markets as a result of, when earnings season occurs and Numeratorville takes over, right? That is bad grip, wrong aim, terrible swing, ball in fairway. And that may be fine in that one instance, but over time it is very likely. And oh yeah, by the way, you've burned time on a time when this, like I said, as a result of sequence risk, right? This can't go down to 50 from 70 because you need to make this money last through here on this diagram, on this spreadsheet. And instead, what we have here is and no fatal ingredients. So in other words, and what this means is your specific situation. And by no fatal agreements, meaning that maybe you think that you like the excitement and gyrations. That's fair. That's fair. That's not my, that could just be your, the way you roll. That's good. No problem. Okay. We can't also have this at the time that you are going to live to 300 years old. Not necessarily. Why? Because, and you're living check to check. So that kind of thing of style and then lower cost. So basically what ends up happening is you've got a couple of options and you have more than one option, right? But you can see it here and make it for scratch. And guess what also does this? This entire formula is creating the replicating portfolio for the call option on a stock. You can create it, and they're pointing out what the ingredients in the minestrone soup is right there. And oh yeah, by the way, as I said, ND1 happens to be this blue curve over here. Happens to be. There's no coincidence about the points that I'm making here on Jay's Corner. They are coming from, not from some voodoo. I promise you that. This is not voodoo. It is simply that it is more complicated than people realize. People get the wrong idea about, their takeaways. They take the wrong lesson from those takeaways, and then they start making errors. And now you can see it. Let's just see, because we're almost to the end. Well, let me just, before I get to the very last, this happens all the time, by the way, right? You think this is only the options market? No. Here it is, right? Let's see. No. Equity risk premium, right? In other words, this is building the replicating portfolio as well, which is people are judging the relative value of equity markets versus other investments and the asset allocation. In other words, the building of the curves, right? The building of the curves is based off, equity risk premium, for example. In other words, what expected returns compared to other asset classes. By the way, this is kept track of. You can see it here. This is equity risk premium index. I promise you, this is not voodoo. And what do we have here? We've got almost the all-time high. And what does that mean? That means that equities are trading at a level very expensive compared to the rest of the planet, meaning other asset classes. Who's using this type of thing? The biggest money in the world, the CalPers, the CalSTRs. They're looking at, okay, because they have other bigger fish to fry, which is to what? Pay pensioners, pay their population. Other countries have their entire foreign exchange, their foreign reserve pot looking at this kind of thing, literally. Government Investment Corp of Singapore. You don't think that they don't understand what this is? I promise you with 99.999% certainty, they know exactly what I'm talking about right now on this simplest matter. What about Acme Asset Wealth Management? Okay. So my point here is that here it is here on how high it is. This is the historical point. Now, don't get me wrong, right? This tells you how well the equity market has done. Does that mean that we are going straight down? No, of course not. Right? In other words, I'm here. I'm here. Right? Which is, this is true in for the one time frame. This is true for the multi, and that has in fact what has happened, which is that you at least need to have some feel for the idea that this is going on. That doesn't mean that it cannot continue. In other words, people wrongfully in finance, when they don't fully understand, what ends up happening is they have the takeaway and then they add their own understanding or interpretation, which every time I speak in public about Medicare, I'd say the same thing. I'm going to say up to X. I did not say X plus Y. Right? I'm going to say X. I'm going to stop at X. X dot, period. Right? Not X plus Y that you've gleaned. That was your spin. Let's continue because I'm going to show you the following. And the reason, why am I doing all of this? And here, Capital has a pricing model here. And now you can see it here relative to the rest of the market. In other words, what these are all different versions of replicating portfolio, all of them. So now I've already shown it to you, right? And now you have all of them are using this idea, and even on a single individual security, all using the idea of replicating portfolio. All of them. The idea that everyday people can then be the qualified chef to understand these. It's not decades. It's not due to decades, right? Age is a number. In other words, if you're a 17-year-old genius who's able to plow through the correct data, the correct papers, the correct academia, and have contact with the right people to explain it to you and guide, could you be 17 and understand this? The answer is yes. Do I have to have lived this? This is why I don't like the idea of people saying, no. I don't like the idea that people say, okay, well, I needed to be in the market for 70 years in order to be able to understand this. No. The extra time it isn't due to the fact of just time alone. Time alone, twiddling your thumbs on the wrong idea is not a good use of time, right? So that doesn't by itself qualify you, a point I've made multiple times, but rather so that you can understand the idea that this curve here can change shape, and it can change rapidly and wider than people may think in ways that they have not seen. Just the person with 70 years of experience has seen wider blue curves. I think that's almost it. I would say just you can understand why I have to choose spots to stop. Because I have now opened the door to all of this here, which is then we've got an entire science on behavioral bias. Now, if you Google this term, behavioral bias, you will see a litany of articles. And here's one. So this is Raymond James. I have no affiliation with Raymond James. I just Googled and I just said, okay, let's find an article. And this is one of these bias. Behavioral finance, right? Overconfidence. What does it mean for you? So I don't know where they came with this data. I have not looked at the data here. For example, here we are, 25% of Ford are not at all financially prepared for long-term care costs. I already know this. This is known to people here on Jay's Corner when it comes to financial planning. Illusion that passes success of intrinsic skill, right? Of course, that is correct, right? The red arrow. The red arrow is you are here today. You need to have the correct theory, of which, by the way, the idea that you can, the punchline is still coming, by the way. My point here is that you can see that one study found that attractive traders underperform the 7% annually. Okay. Now, I've not done the deep dive into this study. Let's just say that just this was 1 year. And now you can understand. This is why you can't be this is why when it becomes more volatile, right, we cannot have, you just riding it and then saying, oh, well, stocks in the long run. Because now you've opened yourself up to this, which I have made a point of on many occasions here on this channel, right? You've now opened yourself up to the sequence risk example that I've shown on many occasions. Because it's actually, you have instances of this and you have 7% annually. It doesn't say how many years, but let's just say, for example, this happened for 2 years, right, in a row. You got a problem, right? You will have a problem, right? Because at this time, 100 has turned to 93, and 93 went to 8, for example, and 93, and you needed to use the function of that money, right, to fill roles inside of here to pay for stuff. And now, by the way, the expenses are not 1 point. It's 1.03, yes, but it's on top of %8 in the past, which means that everything's 10% more. So now you had 93 and paying for stuff which is 11% more than 2 years ago, and now you can see the issue. You actually, in real terms, have way fewer Big Macs that you can buy. I make one other, and this actually is then going to be my final point, which is that AI has made this worse. A lot worse. My concern about AI is not the fact that it exists. It is clearly going to transform the world. Every of the large companies is telling you this, right? That their employment's going to change. The employment patterns there are going to be certain jobs which are not going to be jobs any longer. X-ray technicians, you should look very, very closely at yourself in the mirror. That's just my personal opinion, right? In other words, the vast number is not, I don't know. But my point here is that AI can't explain. Can you go to AI and ask them about how replication works? Yeah, you can. Can you get the updated information about what happened in practice down here? You cannot. AI learns through time and multiple publications, of which the issue here is someone out on the planet is saying, hey, see, I told you so. I was right. NVIDIA is going to change the world. The target price is 1,000, 1,200. Which is very different than my explanation that I've shown you with market data about actual practice about what's happened on Friday and what happens in 0 day expiry options markets. The issue here is that as a result, for example, we'll take one last example. Is it one last example? Do we have time? I think we do. So this is ChatGPT, right? So let's just change it to 4. Sure. Okay, no problem. So you can see it here. This is not Watch J Types channel. Tell me what happens to NVIDIA's 0 days to option expiration markets and how it can influence the markets and people's behavior. This is the question that I want to pose. So here's the problem with AI. Number 1, you need to ask it the right prompts, which candidly speaking, the public is, like I said, it's not only the public, don't get me wrong. Acme Wealth Management also does not know to ask this question. So now, if you're not so now we have the age-old saying of garbage in, garbage out, right? If you give it some blurb as a question without being more specific, very, very specific, then you're not going to get a satisfactory answer to answer your question, even if correctly stated. So my point here is if you ask it some vague, wrongly formulated question based off some incorrect understanding, you're going to get garbage out. But let's even see it here. Yeah. Right. This is true, right? But this is known. These are known. Here's the issue. So I like this answer. No, this is the first I've not asked this question, right? Because I asked it the right question, right? Then I can get the answer. And this is a pretty good answer. All else equal. Right? The volatility of the underlying asset can increase. Traders and manipulate, known as pinning, no question about it. I call Fridays, pin the tail on the strike price. Absolutely, that happens on individual stocks, people. Absolutely, this is why Futures Trader 71 says that he preferred index futures trading because it cannot be manipulated in the capital structure. We're not even talking about GameStop and AMC, right? Where people on Reddit would say, buy this and diamond hands and that stuff. Price distortion. That's my point here. Plus 6% is distortion, no question. Traders may engage in speculative. That's fine if you're doing this full time as a living, and then you can ride or die with because that's what you're making your living trying to do. The issue is that's a tactical position, tactical. And by tactical, what that means is short. That's another way of saying very, very short term. Strategy is for long term. And now you see this conflict, which is that even at Blackrock, they're going to have speculator trading to some degree within margins, within thin margins. In the deep end of the weeds here is going to be the leeway for some percent to be. In every mutual fund, they're going to have this issue. But for institutional and regular traders holding options, then on whether to cut losses. This one here is more for institutional money, meaning that they may have hedged off, or more importantly, more specifically, I should say, right? They may have hedged off their overall portfolio, why, just like a household could have, right? Sophisticated households can do this, right? Which is they're hedging off to make sure that they can pay for their and get the money. Why? Because your CalSTRS, you've got to pay a pension. So yeah, that is very possible. Market sentiment, this is my point, influence market sentiment. This could cascading effect if it's a component of those aggregates, which is all true. NVIDIA, third largest stock in the NASDAQ. And that's why I was saying that earlier in this segment that, NVIDIA is not Jay's Rib Shack. Jay's Rib Shack's a penny stock. It's a speculator stock. Up and down 6%, no problem. It doesn't make the headline on Penny Stock Journal. It will not push the index around at all. Who engage in is crucial for traders and investors who engage in current or monitor markets where financial instruments play a significant role. Who is that? Everyone. It's everyone. And that's why now you can see the segue and the combination between these. How I started today's video may look like two different topics. They're not. Which is this first, the way that this premise here, right? You have what people do is they don't convert into they don't focus on the function. They're focusing on the result. They take the result from here. And then, but the reality is that the influence to everyday people that are not professionally investing at high speed, high frequency trading, for example, options traders, options market makers, that the issue is that while this gets the headline and plus 6.1%, it has changed as a result what has happened and distracted people. And by the way, you may not have understood that these are actually the mechanics of what actually is going on inside of the way that these, even down to the single instrument, works. That's how far removed you actually, and this is only one simple example. This is not even close to the litany of different examples that I could talk about when this is true. And now what you can have is, now this is tough. I'm going to tell you this is very difficult. Could I call it unfair? I'm not a person that defines fair. Right? I'm with Stephen A. Fair is a place where you judge pigs. So I'm not here to define fair. Is it overwhelming? Yeah, it is. Why? Because now you are the person responsible here, as we discussed last week. Which is that since this guy is gone, you're having to do it. BlackRock's new product is a partial approach to it. It's not a perfect approach. It still has black box inherent characteristics that people have to be comfortable with. But for some people who don't know, don't care, sure. I mean, I don't think that there's anything wrong with its concept. Whether or not its actual math is going to be attractive is a different matter. This is not the only time. So it's back to what I have said in the past. I'm not a person to say, I'm not Chicken Little. To say we have I understand retirement crisis is a statement that lots of people like to cling on to. But reality is I'm more about the idea that this is a knowledge crisis. And this here when I was talking about NVIDIA options, gives you an idea that even if you understand every video that is here on this channel, that's the stuff that I've said. And that's the stuff because that's the stuff that I thought and I've exceeded. I'm very sure to many that I've exceeded the limit of what they can take. That's fine. That's not even close to where we are going or where I could have taken this. And there's only going to be a limited number of views to my videos as it is. That's why we have like less than 10,000 and why other channels have hundreds of thousands, because I want to debate wokeness. Instead, I would rather have told you, look, this stuff is happening, and now you can understand why I might have said we don't have necessarily a retirement crisis. We have a huge knowledge crisis. I'm not the only person to say this. Let's take a look at this. Here it is. This isn't today, right? This Harvard Business Review. Harvard's this, lowly school on the East Coast compared to, University of Chicago, lowly. Just kidding. I'm not one of those. Anyway, my point here, this is Harvard Business School's, very, very famous magazine. Robert Merton, Crisis in Retirement Planning. See, he's not talking about crisis in understanding portfolio management. He's not. In retirement planning, however. Oh yeah, by the way, this old person here, old, that guy here, that guy has, a very nice gold medal sitting on his, coat rack by Alfred Nobel. Right. In other words, this has been here. This is not today, right? This magazine's the original publication date, July, August 2014. 10 years ago. And how many years did he work on this in order to, before he decided to even write this article, right? So this is not new. This here is a very interesting way of looking at it. I would not have taken it from here as far as your, ability to check stuff or to get your information or get your conclusion. You can see how damaging it can be, right? The idea that you think, oh, see, it turned out, therefore I was right. Now you can understand why I used that as my silly, childish analogy, for example. I've seen this a lot. And then what ends up happening here is that you can see now we've got more work to do over here. All right, everyone. That's enough for today. Enjoy the rest of your weekend. info@gh2benefits.com. Be sure to like and subscribe if hopefully you've got something from today. Well over the 1 hour target. Once we get on a roll, because of the fact that I don't have tons of time, we don't know what my schedule would necessarily be. I don't need this channel for anything, to be candid with you. I'm just here to share the ideas that, it is not that people have overestimated the task. It is that they have underestimated the task. They've underestimated how many layers to the onion there can be. You're not responsible for knowing the layers to the degree, anywhere close to the degree that I've shown. The issue is that the idea of doing it alone is a hard no. And as a result, now the challenge then becomes, okay, does your person understand, and are they doing the job that you're assigning? What is the job? It's your responsibility to define that job ultimately, right? The idea that you would hand out over, okay, what, that they would tell you what their job is, no, I just don't. That is you handing over the controls to somebody else. Your preferences, your experience, your situation. No, right? Doesn't matter. I could be, in the absence of being a direct family member, and even then, times change, right? You can move away from your sibling. Your sibling then, adopt some new philosophy. Even then, no. And then you have focus on this job first, then, and only then, all of these instruments, other aspects that I've explained here on the channel. All right, everyone. Have a good weekend. And we will see. Be sure to subscribe to jo.substack.com. All the links there below my talking picture. And remember, as always, not financial advice. Thanks.